this was really close to my heart. I've been meaning to do an education series on investing in syndications for quite some time, and I'm glad things fell into place and we're able to make time for it. I'm so excited to deep dive into this. A little bit of background. Last year, I had a few friends who were in last year and this year who were investing in real estate syndications, and they wanted to invest in real estate passively. I was super excited for them. Investing directly and owning your own portfolio, it's not for everyone. Everyone doesn't have the desire to do it. A lot of physicians particularly don't have the time or the bandwidth to be growing their active portfolio, especially when they're not in a program or in a close-knit community. That's totally understandable. But the thing is that as I was watching my friends and people within the program and people I know start investing in syndications, especially when it was their first few deals, I started to notice a few problems. All right. So just to let you guys know, let's call her X, right? X is a very close friend, very savvy financially. And when she invested in her first syndication, what she told me was that she loved the sponsor and she was committed to the deal. But when I looked at the deal, I realized that, the returns per se, it was very hard to understand what the actual return was going to be. And I felt that it really did not match her strategy for investing. And we had conversations for a few months, and eventually she realized what I was talking about when I educated her. I talked to her about industry standards, and so there was that experience. And then I also had another close friend and member, let's call him Y, who also invested with a syndicator. Again, great business plan, amazing business plan. But there were no performance projections provided to the investors. The sponsors did not really have a track record per se. They had done this on a smaller scale before, but they hadn't come full cycle. And I was concerned that it didn't really completely fit with his risk return profile, right? So that was a concern that I had. And as I saw more people invest, I had another one of my dear investors. He's now invested with us, with GW Capital, quite a few times. He initially, this was last year, he brought a deal to me and he asked me with, giving me the slide deck to vet the deal for him. And I was, and for those of you who've brought me deals, you know that I'm more than happy to look at any syndication opportunities that you're looking at, and I help you figure out if the risk reward profile makes sense for you. And so I looked at the deck that was given to me, and I told him that, hey, this looks good, but I really to be able to see, because what you're seeing on the slide deck is just the polished picture, and to really know what's happening, you need to look under the hood. And I asked for detailed underwriting and sensitivity analysis, which every sponsor should be able to provide to you, at least sophisticated sponsors who are doing detailed underwriting, which your sponsor should be doing. And I never got it. So I wasn't really able to help him. And so what I realized is that as there is growing interest, as more and more physicians are investing in syndications, I also realized that oftentimes decisions were being made based on how much they knew, liked, and trusted a sponsor, or based on a business plan that was being pitched to them, but without really having strong metrics, performance projections to base their decisions on. And when you don't have that, it's really, really hard to see if a project fits with your risk return profile, right? And this is why I created GW Capital. I have been a co-GP with a couple of my mentors, and I've tried to bring curated, vetted deals to the community. The goal has always been to have transparency, accountability, and leverage for our community. At this point, by the end of 2022, we'll have over 800 drawers under management, $150 million, over $150 million worth of assets under management. If any of you want to learn more, go to generationalwealthmd.com/syndication. Many of you, and again, I'm honored by the trust that you've all placed in me. I'm completely blown away. A lot of you weren't able to get into our Greenville deal. You were then able to get into the Atlanta deal, but we had a long wait list for our last syndication opportunity in Atlanta. And for those of you who weren't able to get in, and for those of you who want to get into one more deal before the end of the year, our current offering is available at generationalwealthmd.com/Atlanta. So go take a look at it. It's a fixed 3.6% interest rate, return of majority of capital in year 3, and it's a targeted close in 2022. It's not guaranteed, but we're targeting it. So again, it's another awesome deal that I'm very excited about. But as I've been doing this, I realized that I wanted to bring the resources to the community. I realized that the greatest impact would be with education, and that's why I am committed to doing this education series for you guys, and I'm hoping to do more and more episode sessions where we deep dive into topics that you like. So I'm open to feedback. This is the first time I'm doing it. I'm very excited. But if there are other topics that you want me to focus on, please make sure to let me know. Some of you are interested in investing as passive investors in syndications. A lot of you have been in the coaching program, Creating Generational Freedom, and you're doing both active and passive investing. And there are ways to strategize around that to really boost your returns. And I find all of that very interesting. But the truth is there is a lot of confusion and vagueness around deals. There are a lot of myths. And in this 2-part live series, my goal is to empower you with the tools that you need to be able to do your own due diligence. You probably heard people say that when you're investing in syndications, you need to vet the sponsor, and that is more important than vetting the deal. And that is absolutely right, but it's not the entire picture. Okay. And so the way I like to look at investing in syndications is 3-pronged. The first part is going to be clarity of why. What is your vision, and why is it that you're trying to invest in syndications? The second part is going to be vetting. And when you're vetting the market that you're investing in, the sponsor, and you're also vetting the deal. Okay, so it's 3-pronged again. And then the last part is going to be putting all of this together, right? Knowing your why, knowing how to vet a market, the sponsor, and the deal, and then looking at a deal and seeing if the risk return profile is what you're looking for. So it's actually plugging everything together and seeing if it makes sense for you. And I'm hoping that by the end of the 2-part live, you're going to look at an investment deck, a slide deck. You're going to look at a PPM, and it is not going to confuse you. You're actually going to be excited about it because you really want to deep dive into it. Okay. Hopefully, you guys have heard about Simon Sinek's Golden Circle method, the model. And what the model actually entails is it's like having 3 circles. And the outer circle is the what, the circle inside that is the how, and then the inner circle is the why. And Simon says that everybody knows the what, right? So if you're thinking about, if in any business, right, the what do you do? Everybody knows that, right? What deals do you invest in? Everyone's looking for that, and they're trying to make decisions about that. But the more important thing, and what fewer people know, is how. How do you get to that point? How do you do what you're doing? How to vet a market, right? How do you vet a market? That's difficult. And then the inner circle, which is the why, only a handful of people really know their why, right? So why are you investing in syndications is super critical, because like Simon says, successful leaders think from inside out, right? So it's not about the what deals am I going to be investing in, but you start with the why and you go on to the how, and then we look at the what. And that's what the focus of this 2-part live is going to be. We're going to start off with why you should be investing in syndications, why it makes sense for you, and how you're going to alter your strategy based on that, because one size does not fit all. The second part is going to be, like I said, vetting the sponsor, the market, and the deal. And I'm going to talk to you about industry standards. What I realized is that I've been doing this. I've been a GP for a while now. And when you're just starting out as an LP, a lot of times you don't know what industry standards are, which is why understanding a deal is hard, but also it means that you end up learning from your own mistakes, and we're going to eliminate all of that, right? We're going to talk about industry standards so that you know what most deals look like, and you can use that to vet the deal that you're looking at. And then the third part is the fun part, is where we're going to put it all together and say, Okay, so what deals are good for me that fit my risk return profile? I'm going to teach you how to do your own risk return analysis and how to stress test the deal. If you are in the Creating Generational Freedom coaching program, you know that we're all about stress testing. That's very important. We're going to learn how to do that with syndications. Okay, perfect. Let's get started. I'm going to start off with the basics because I know some of you have been investing in syndications for a while. You're sophisticated, you're already pros, but a lot of you are just beginning to think about it. And I want to start from the basics. So what is a real estate syndication? It is when a bunch of people, so a lot of you as investors, pool your money together to invest in a larger asset, multifamily apartment complexes, 100 units, 200 units, 300 units, right? This is not something you could do individually, but when you pool your money together, you have the funds available to do it. And within a syndication, you have general partners, also called the sponsors or the operators or the managers, who are doing the work of identifying a deal, underwriting it, which means they just running the numbers, seeing what the income's going to be, expense is going to be, how we're going to add value, how we're going to exit, actually acquiring the asset, managing it, and making the decisions about exit. So all of that is being done by the core team or the general partners. And then you have the limited partners, which would be the investor who wants to invest passively. You put your money into the deal and you get returns. And limited partner is based on older terminology because they used to be limited partnerships, but it still does mean that you have limited liability in the deal, even if you invest as an individual. The structure of the deal, which is typically an LLC, protects you because you have limited liability in the deal. And so you're called a limited partner. Okay. So the first question is going to be, why are you investing in syndications? And there are three primary reasons why people invest in syndications. And the first one is going to be returns, right? And I want to break this down in two different ways. Now, returns, and this is really, really important, okay? If you've listened to me before, if you've been part of my lives, of my lives in the past, you know that I really deep dive into this. And the goal with syndications for most of you is to get the highest risk-adjusted return, right? And so I'm going to talk in a little bit about what returns look like along the spectrum from index funds, which is where most of us invest, especially with our retirement accounts. And if you're like me, that's probably what you've been doing for a long time, right? And then you start thinking about real estate, and then you have this whole spectrum where you have syndications or passively investing in real estate, as a limited partner in a syndication. Then you have direct ownership, where again, you can be super passive. You have a property manager, you're just buying something that's turnkey. And then you have on the opposite end of the spectrum, something like a short-term rental, which is something we deep dive into in the coaching program. A lot of you are acquiring short-term rentals right now. The returns in that can be massive, right? So you have this whole spectrum. And the thing to remember is that with real estate, as the returns increase, there are ways to de-risk your deal where your returns are increasing, but you're actually taking on less risk than if you were investing in the stock market. And I'm not going to go into that too much, but with the stock market, you have market volatility, you have a sequence of return risk, which is when the market drops and your income, your retirement nest egg may not last you as long as you need it to, which is what happened during the 07-08 crisis. So when you invest in real estate and you really know what you're doing and you know how to de-risk your deal, you're increasing your returns without a proportionate increase in risk. And that's the important point, right? So this spectrum that I talked about, we're going to break it down into actual numbers. And the reason I'm giving you the numbers, and I want all of you to try to do this, hopefully some of you have already done this because you've been part of the ecosystem, but financial independence is a game of returns, right? It's a game of returns. And how fast you get to financial independence is going to be dependent on your returns during growth, which is when you're aggressively saving and investing, and then your returns during retirement, which is when you're living off of your nest egg, right? So two different numbers. And I always talk about returns in terms of those two different numbers. Now, for those of you who haven't used my retirement calculator before, if you go to the Generational Wealth MD website, generationalwealthmd.com, go to the resources section. I have a financial independence worksheet over there. Download the worksheet, you get an Excel calculator, and you can actually plug in your actual numbers. And I actually, earlier today, before hopping on, when I was looking at this, I was like, I'm actually going to model this out and give you actual numbers. So you can actually see the impact of increasing your returns, right? And if you don't really understand this, you're going to pick the wrong deal, that one that doesn't make sense for you. And you're also likely going to have more hesitation when you're thinking about getting into a deal, because when you really understand why you're doing it and what impact it can have on your life, on the life of your family, that's when you're propelled and motivated to make a decision, right? So let's look at those numbers. For in stock market, when you're investing in index funds, right, your returns during growth, they're going to be on average, historic averages, right? If you're primarily invested in index funds, without, if your portfolio is no bonds, just stock market, invested in index funds aggressively, right? So 10% is what you're getting. And we're giving stocks the benefit of the doubt here. So 10%, right? Now, during withdrawal, when you retire, you can only withdraw 4% from that annually for that nest egg to last you 30 years. And then realizing that is when I made my completely shifted into real estate, because I was like, with a 4% safe withdrawal rate, if I wanted to get $10,000 a month in passive income, I needed my stock portfolio to be greater than $2.5 million, close to $3 million, right? And I was like, that would take a lot of time. Okay, so those are the numbers for the stock market. If you look at investing in real estate syndications, and that's very similar to buying turnkey rentals and renting them out, if you're not being, employing any strategies to boost returns or get aggressive. When you're investing in syndications, your returns, your average annualized return, which is what is, in my opinion, the best way to compare your returns to the stock portfolio. Now, day 2, we're going to break down IRR and other metrics that you would use to compare your syndication investments to other syndications. But when you're comparing it to the stock market, I like using average annualized returns, because it's a better way of assessing it and keep comparing apples to apples. For syndications, your ROI during growth, your average annualized returns are close to 20%. Okay, and when we're looking for your number during retirement, when you are retired and you're living off of your syndication investment, you may choose to invest less aggressively in syndications. And so, just to be very conservative, we're going to bump that number to 10% during retirement for syndication investment. If you're investing in something where you buy Class A shares, all that means is that you get a guaranteed 10% return every quarter on your money, and you're not looking for any upside, right? So those would be the numbers for investing in syndications. Now, if you're investing actively in real estate, those returns could be, and you're rehabbing, you're doing short-term rentals, you're using strategies to boost returns, those numbers could be really high. Some of our members are getting 100% ROI on their investments in year 1, just because of having short-term rentals and using tax strategies. But conservatively speaking, it could be 40% during growth and 20% during retirement, right? So now that's the spectrum that you're looking at. And so if I were to say that I wanted to get $10,000 a month in passive income, and I was able to save $5,000 a month, right? And I'm investing that in the stock market with those returns, and you could model this in the calculator, you can put these numbers in. With the stock market, it would take me 18 years to get to financial freedom, for me to get to the point where I could just live off of my nest egg. Now, with the way syndications are, with the returns being higher, I actually modeled this out, and you can plug the same numbers in. You can plug in the numbers that make sense to you. So to be able to get $10,000 a month in passive income from syndications, just because of the returns being higher, with the same amount of money going into the investment every month, it takes about 8 years to get to retirement, right? So that's the impact, right? 18 versus 8. That's the impact of boosting your returns. And that's why most of you are thinking of investing, and hopefully that's why most of you are thinking of investing in syndications, right? Because you really want to get to financial freedom that much faster. That's the most important thing to remember. Now, for some of you, you may want to, it may not be about the returns. You may be okay with getting a 10% annualized return on your syndication investments, and that's for you to decide. But I want you to make an informed decision, because if you're not conscious about this, that's going to, it's going to impact your investing journey for the next decade, right? So this is something you need to think about right now. The second thing I wanted to hit upon is, in the current environment, because this is a question that a lot of you have been thinking about. I did a state of the market last month where I talked about this, and just to briefly highlight it, in the current environment, if you're holding on to cash, the question is, what do you do with your money, right? Interest rates are high. We may be going into a recession, and property prices could drop a little bit. The stock market. So what's going to happen? Interest rates are going to go up. If you're sitting on cash, we're still in a high inflation environment. Inflation is still at 8%. Your cash is losing purchasing power, right? That's not the right strategy. Bonds, again, this is not the time to be investing in bonds. Your returns are going to be really, really low. Vanguard came up with their projections for how index funds were going to perform for the next 2 years, and they anticipate returns to be 4 to 6%, right? So that's what we're looking at. And when you look at real estate, even with interest rates being the way they are, even with the projections for the next few years, if you're picking the right market, if you have the right debt structure, because that's going to affect your ability to hold on to a deal and to be able to weather any market corrections. If you have a conservative deal and you're underwriting conservatively, we're still looking at a greater than 15% average annualized return. And that's, for most of you, that's going to be the big reason why you're going to continue to want to invest in real estate at this time, right? Because it's a comparison about how other assets are projected to perform and what we're actually seeing with real estate. And as long as you have the ability to hold, you're investing in the right deals, then it makes absolute sense to invest in real estate. I'm still bullish about multifamily, bullish about real estate. Okay. So the first reason to invest in syndications is going to be why, and you really need to know what returns you're looking for it to make sense to you, for you. And this is why I really recommend that you download the calculator and you plug your numbers in and play with it and really see what an impact investing in syndications can have for you. The second thing is going to be diversification, right? I've even had people who are active investors who've gone through the program, or close friends who have invested in our last deal in Atlanta because they wanted to diversify across markets and they weren't comfortable with an out-of-state portfolio that they were managing using property managers. So multiple reasons. So diversification across markets. A lot of you want to be investing in inflation-adjusted assets that are not correlated to the market and that are recession resilient. And so just diversifying out of index funds is a big reason for people to want to invest in syndications passively. Right? So returns, diversification, and finally tax advantages. Now, real estate per se is tax advantaged, and when you're investing in syndications as limited partners, those tax efficiencies are passed on to you. This is especially beneficial to those of you who also have other sources of passive income, because you're going to see a huge boost from tax savings in year one, which is why a lot of you want to get into deals this year, because 2022 is the last year for 100% bonus depreciation. And if you have passive income and you're able to take the passive losses that you get this year and immediately offset your 2022 passive income, you're going to see a huge boost in your income, right? Your effective tax rate is going to go down significantly. And so for those of you with passive income, even for those of you who don't have passive income, all your returns from the syndication are going to be offset by depreciation losses that you get. And at the back end, when there's a sale, yes, there is depreciation recapture, there are gains, but there are ways to strategize around taxes at the back end, either with a 1031 where the entire LLC can 1031 its interests, or laddering with other syndications that you may be entering, or strategizing around other passive losses that you may have, right? And this is something that we can have conversations about. If anyone wants to talk about this, feel free to reach out to me, book a call with me. But there are those tax advantages, right? And so those are the three reasons why you're investing in syndications. It's important to remember this because that's going to drive your decisions in terms of what deals you pick. Now, before we move on to vetting, right? The next part, how do I vet a deal? How do I vet a market? How do I vet a sponsor? I want to take a little bit of time to talk about, when you're in the why part, I still want to talk about a few things. Risk, right? Big question is going to be risk. Now, like I said, there's always a spectrum, even within real estate, where the deals get riskier, right? And you've probably seen diagrams where they talk about this. So the less risky deals are your core and your core plus assets, where you have stabilized deals that are throwing out cash flow and you're getting lower returns, but that's significantly lower risk, right? Then you have in the middle, you have value add deals where you're going in, you're doing a rehab, you're adding value and rapidly increasing the value of a property. And that's the beautiful thing about multifamily. When you're increasing your income, when you do a rehab and you can rent it for a higher rent and you're increasing the property's overall income, and even raising rents by a few $100s per unit can have a massive impact in terms of millions of dollars in the net worth of what the property is now valued at, right? And so value add is like in the middle. You buy an asset that's stabilized, that's already built up, it's cash flowing, but you go in and you add value and you're significantly boosting your returns by increasing the property value dramatically, right? So that's in the center. So a lot of syndications you will see, if you're trying to get to that 20% annualized returns, that's where you want to be. You want to be in that value add, which isn't risky because it's already a built up asset, it's already cash flowing, but you're adding value to it and increasing your returns, right? And then you have the highly opportunistic deals, which is where you're going in and doing ground up developments, right? Or it's like it's a massive value add in a class D asset. So again, so you have core plus core plus value add and opportunistic deals, and you get to pick with the deal that you're going in what makes sense for your risk profile. So I always say, always think about your risk profile and know what it is before you even start looking at deals so you can see if it makes sense for you. Same thing with markets, right? There are markets that are, and we will talk a little bit about this when we talk about vetting a market. There are ways to pick really strong growth markets and markets that are very landlord friendly. That's de-risking your deal per se, right? And so that's another way to manipulate risk and to make sure it fits with your risk profile. Now, the other thing is the class of the property that you invest in. And I'm going to quickly talk about this for those of you who don't know about it. When we talk about real estate, we talk about 4 classes: Class A properties, Class B properties, Class C properties, and Class D properties, right? And so Class A properties are your new properties that are, top of the end, granite or quartz countertops. They are highly amenitized and they command the highest rents. And they, you have white collar people in white collar jobs over there. Class D properties on the other end of the spectrum are older properties in neighborhoods with a lot of crime and a lot of blue collar jobs, a lot of the tenant base is very different over there. And then B and C falls in between that. And you can pick where you want to be. Most syndication deals are going to be Class B or C, and some of them are going to be Class A. Again, with Class D, C, like I would say most syndicators stay away from Class D properties, but Class B and C properties, you're going to have a higher return. Okay, C, especially with C, higher return, you can have higher upside when you rehab them, but there's slightly higher risk just because of the tenant base. Class A properties, you may have lower returns, but you also have lower risk, and you can decide where you want to be. So when you're assessing your return profile, also assess your risk profile and know where you want to be, and you can use that to analyze a deal. Now, the next thing is going to be, what are you looking for? Are you looking more for cash flow on a monthly basis? Or is that really important to you? Or are you looking for capital growth? Do you want those higher annualized returns over time because you're trying to boost your returns and get to financial freedom that much faster, right? This is going to be different for different people based on your risk appetite and based on where you are in your financial independence journey. And so I want to mention this. I've spoken to a lot of you who are investing in debt funds, right? Where you're getting fixed returns of 6 or 8%. And some of you are investing in REITs where you're, again, in that 8 to 12% returns. Now, both debt funds and REITs, the returns are significantly lower than what you see with value add syndication. And then they're also tax inefficient because the distributions that you get and the interest that you get, you are paying taxes on them, right? So those will be the disadvantages of those asset classes. And then you have syndications, and even within syndications, I just want to mention this. You have different classes within a syndication, right? You have different classes that you could pick as a limited partner. I'm going to talk about the 2 really important ones that you need to know. Class A typically tends to be those investors who want to have guaranteed cash flow every month. So like in the deals we've had recently, Class A investors get guaranteed 10% returns every year that they're in the deal. And then they still get the tax benefits. A bonus depreciation is passed on to you as a Class A investor. You have the tax efficiencies, but you don't get any part of the upside. So at the end of the deal, every year that you've stayed in the deal, you get 10%. That may be okay for you if you're more focused on cash flow. But a lot of investors, a lot of you on this call are going to fall into the Class B category. And what Class B means is that you get a preferred return, which means you could get, in the deals we have right now, it's anywhere from 7 to 8% is what your preferred return is. So for every year you're in the deal, you are going to get 7 to 8% in terms of cash flow. You may not get that upfront, That's the difference between A and B, because initially we're doing the value add, we're turning the units, we're trying to increase rents. And so cash flow can be lower. It could be 3 to 4% the first few years, and then it starts going up. But at the end, oftentimes this is cumulative. If you haven't received it initially, at exit, you get that 7% return to you for every year that you're in the deal, but you also get upside, right? So you get a portion of the profit split, which is what boosts your return significantly. And you need to know which makes the most sense for you. And I've had discussions with so many of you, some of you, especially those of you who've been investing in debt funds. It's a big step, just invest in a syndication. And you may not be comfortable with just the Class B because you're used to getting that monthly cash flow. So there is a way to do blended returns where you could invest 50,000 in Class A, 50,000 in Class B. And we model that to show you what that would look like in terms of annual returns. That's going to be significantly higher. You're getting higher cash flow, and you're also getting more upside than you would as just a Class A investor, right? But knowing where you want to be in terms of capital growth versus cash flow, where you're in terms of risk, where you want to be in terms of your return, all of that is super important. And then finally, I want to talk about hold periods, because I've been getting a lot of questions about longer hold periods. And I just wanted to break that down because what you have to realize with syndications is that there is a curve, right? In terms of what your returns with a syndication do. The first 3 years that you're in the syndication, that is when, especially with value add syndications, that's when we're going in, we're catching up all the rents to get them to market rent. That itself can sometimes be a 10% boost in operating income, which increases your property value again. And that's what we've seen in the last deal we had in Atlanta. That's what we're seeing with the current deal we're having in Atlanta also. So that's when you're doing that. You're catching up on your loss to lease. That's when you are doing your rehabs and you're increasing your net operating income, massively. And what happens is that year 1, year 2, year 3, your income is going up significantly. It's a steep upslope. And after that, your returns get muted because after that, you've stabilized the deal, right? And with a longer hold period, what you have to realize is that, which is why most syndicators at the point when they're getting close to stabilization, they're going to start looking for exit, because as an investor, right, you've already decided to be passive in this investment. Now, the question is, do you want the upside, the massive returns, which is going to be 2 to 3 times what you're getting when the property is stabilized? Do you want to have those significantly higher returns till year 3? Or do you want to hold your money once the asset is stabilized? And that's lazy money. That's passive at that point. It's like just, there's no, it's just free flowing. Now, if you're already passive in the deal, wouldn't you want to invest for the upside where somebody else is doing the work? Rather than holding it in that period where you have muted returns because the asset is already stabilized. You're already passive in the deal, right? That's a question for you to answer. Everyone's not going to have the same answer, but it's something that you really want to think about seriously. So then the question then becomes, what about risk, Param? If it's a longer term hold, isn't it less risk? But if that long hold has an initial period of value add, then you're already taking that risk, the slightly increased risk that comes with a value add property, because that property is going to be stabilized, the value is going to be increased. You're already taking that. And most syndicators, even when they plan to exit at year 3 or year 5, they're modeling it out to see what will happen if they need to hold it out longer. And they have the ability to hold the deal for longer if it's going to give their investors the upside. So it's not necessarily less risk when you have a longer hold period. Most syndicators, sophisticated sponsors, are modeling for a 3 to 7 year hold period, and they have the ability to hold if they need to be able to give investors the returns they need. The question you should be asking yourself is, do you want that upside when you're a passive investor? The higher returns? What about liquidity? Are you okay with having a big portion of your capital tied in for a long period of time? When you're investing in your typical value add syndication, the goal is to give you 2 times your money, so your capital, and so 2x that in a 5-year hold period. And sometimes that's 3 years, sometimes that's 7 years, depending on market conditions. But the goal is to remove all of that capital and return it to you so you can take that and then put it into another value add deal where you're again boosting your returns. Because like I said, it's a game of returns, right? How fast you get to financial freedom depends on what your returns are. And if you are risk adjusted, you want to have the highest risk adjusted returns, right? So you want to think about your returns when you're in a long hold, your liquidity. In my opinion, you're oftentimes not, if it's another value add deal that you're going into, the risk is already there. You're already, assuming that risk. And then when you're investing, so I always talk about long-term holds when I talk about having your direct ownership portfolio. Now, that's different from investing in a syndication because you don't have the step up in basis or the ability to 1031 at exit with your hold in a syndication, right? So oftentimes you have tax consequence, or you strategize around it at that point, which you can do if you're exiting in year 3 or year 10, right? So you don't really have the tax advantage of long-term holds that you do with direct ownership of real estate because you have an ownership interest in real estate. You're not directly owning real estate. So that's something to think about. And what I have seen modeling a lot of these, the long-term holds versus shorter-term holds out is that yes, you may have capital gains that you have to pay on your gains at exit with a syndication where the exit is 3 to 5 years. But like I said, oftentimes there are ways to strategize around that at the time of exit. But even with that tax implication, your returns are significantly higher when you are in a value add that is what we call a buy and wait, right? You buy and you don't hold, but you wait to see the right point of exit to give you the most returns, right? And so your returns are significantly high. So the point is, don't let the tax tail wag the dog. You need to look at your investment returns and not just the tax implication. If you have a little bit of a tax implication, but your investment returns overall are significantly higher, then that's something that you need to think about intentionally. Okay, moving on. So we talked about why. We talked about, why you're investing in real estate. It really talked about your risk returns and what your overall goals need to be. And when you really know the answer to all these questions, then you can look at a deal and be like, hey, you know what? This makes sense for me, or this really doesn't fit my risk return profile. Okay, now I'm going to move on to vetting. Now, as I said, vetting is again 3-pronged. It's vetting the market, vetting the sponsors, and then vetting the deal. We're going to talk about the deal on day 2, but we'll talk about vetting the market and vetting the sponsor today. Now, vetting the market is very similar for those of you who are in the Creating Generational Freedom coaching program. We talk about this a lot, deep dive into it. It's very, very similar. When you vet the market, when you understand market dynamics, you're de-risking the deal. And ideally, a good sponsor is already doing this for you, but I'm just going to go over a few metrics, like a few of the broad, like zoomed out perspective of what you should be looking at and how that affects you so that you feel like you have an understanding of it. Typically, you want to invest in a landlord-friendly state. And why? This is because if you need to evict someone because they're not paying rent, and because this affects your bottom line, you're able to do it much, much faster in a matter of weeks in a landlord-friendly state, as opposed to in a state where laws are tenant-friendly, where it could take months, right? The Sun Belt, which is the Carolinas, Florida, Tennessee, Georgia, Texas and Arizona, they're typically landlord-friendly states, which are also business-friendly. They've seen so much migration during the pandemic, but in general, a lot of migration happening there. I like investing in the Sun Belt area. A lot of real estate investors do, and that's the reason why. Now, the next thing you want to look at is demographic data, right? So what is demographic data? Is there job growth? Is there income growth? Is there population growth, right? Those are the big ones. And for those of you who are looking for an easy resource, I like citydata.com. I've used this a lot. We use this even for analyzing our direct ownership portfolios. This is really important, and you can gather the data from there for a zip code or for a county. So you're looking at those metrics. You want to see consistent job growth, income growth, population growth. You want to see industry diversification. It cannot be based on a few major industries. That is just taking on too much risk. The next thing you want to look at, and this is something that is really important for multifamily investing, is median household income. Now, why is this important? A lot of times you'll say sponsors in their underwriting, they'll talk about, we're going to increase rent from $1,000 to $1,200, and they will show you rent comps to show that this is what other apartments are renting for, that are similarly sized, that are upgraded. But you need to know that the population over there can sustain that, can pay that rent. And that's where median household income comes in. Now, let's take an example. Suppose median household income is $72,000 annually, right? So that's $6,000 a month is the median household income over there. And typically, people can allocate a third of their income to rent, which means that rents can go up to $2,000 over there. And so your underwriting should support that, right? And it's a very easy way for you to make sure. And most sponsors, sophisticated sponsors, are providing you with this data, and then you can easily look to see, oh well, that makes sense. And oftentimes there's a huge discrepancy. Your rents, your projected, your target rents may only be 1,700, and you have 72,000 in median household income. You know that you're going to be able to increase your rents to that point, and the population is going to be able to pay the rent in that area. That's important. A good sponsor is also showing you market study, where they're showing you what rents are like in other apartments that are of the same vintage. Vintage just means the year that it was constructed in. And so you want to look at the market study. You want to look at rent comps in the area. And you also want to know what rent growth is like. Now, Atlanta, the market, the southern Atlanta submarket that we're investing in, rent growth was 18 to 24% year over year, right? Now, just knowing that is helpful. When we talk about underwriting, I'm going to talk about how you don't want to put that in the model. You want to be very conservative in your assumptions, but knowing what year-on-year rent growth is very, very helpful for you to analyze a market. Other things like good school districts, low crime, being in the path of progress, having a Whole Foods, having Starbucks, Trader Joe's, all of that, those are good things to look at. Real estate is hyper local. And so to say that, the market is doing poorly, or the market did poorly, is not really accurate, because every sub-market, responds differently to different market cycles. And that's important to remember. So that's about it for market. I'm keeping it very simple, giving you a broad overview. Let's move on to sponsor. Okay. Now, how do you vet a sponsor? When you're trying to vet a sponsor, and this is a big part of what you're doing, right? You really need to know, like, and trust your sponsor. And I feel like vetting a sponsor is two-pronged, right? A big part of it is going to be their ability to deliver, but then you want to know if there is alignment of interest, right? So those are two things. So let's start off with ability to deliver. This is easy. You look at the track record. And when you look at the track record, I want you to look at their track record in that sub-market, okay? So at least in that market, in that MSA. Look at their track record for in that specific asset class. So do they have experience in managing 200 plus unit apartment complexes or 400 plus unit apartment complexes, whatever matches the deal that you're looking at? Because managing apartment complexes that are under 100 units is very different from managing larger assets. So you want to see that they have track record. And if they don't have track record, make sure that they're partnering with people, with co-sponsors, they're boots on the ground. They have someone in the team who does have experience in that submarket, or with that size of apartments. That's really important. The next thing is going to be assets under management. So what does their current portfolio look like? How many market cycles have they survived? How many times have they gone full circle? Have they met expectations when they did that? Were they able to maintain distributions? And if they weren't, that doesn't always mean that it was the sponsor's fault. Sometimes market cycles shift, and they are maneuvering what is out of their control. But you want to really have those discussions with them, right? Did they have a capital call ever? And then, like I said, I like it when the sponsor team is 2 to 3 sponsors at least, because everyone has their zone of genius. And it also takes away the risk of a sponsor having a health issue and then, not being able to monitor the deal, right? So that's something I like to see. What is their relationship with government-sponsored enterprises? Because that's Fannie Mae, Freddie Mac. That's going to affect their ability to get really good loan terms. And so that's something to look at also. So that's what we look at to see if they're going to be able to deliver, right? So that's one part of it. Now, the next part is going to be alignment of interest. So how do I know that they are committed to the deal and committed to performing well in the deal? And I think the most important thing here, and there are so many different ways to look at this, and a lot of them, the factors that are looked at, I think, have pros and cons, and there are perspectives. But the important thing to remember is that when someone has a brand or a reputation that they've taken years to build, they're committed to it, because it just takes seconds to just destroy your reputation or destroy the brand image, and that's not a risk that they'd be willing to take. And so it's really hard to gauge the character of a sponsor, but when they have a brand or reputation to protect, that gives you confidence that their interests are aligned with yours. And the other things, they need to be transparent. You want to make sure that they're providing you with the data you ask for. Communication, they have to be very responsive. And oftentimes you want to know if they are the loan guarantors or if they're using a loan guarantor, because if they are the loan guarantors, then they are more committed to the deal. When you come down to other things such as sponsor capital investment, yes, I always invest alongside you guys. The sponsors that I work with are my mentors and close friends, and they also always put their own capital in the deal. There are different perspectives. That's again something where there are pros and so it's not like everyone has a different perspective about that, but we do invest with our investors. It's something to look for. I don't know if it's a make or break. The next thing would be profit splits, right? So profit splits, I want to give you what industry standards look like, right? So when you're investing in syndications, most sponsors will have a 70-30 split for the syndication, which means that having a 70-30 split just means that the LPs, those of you who are investing passively, at exit, whatever profit is there after the loan is paid out, after your capital is returned, after your preferred return is paid out to you, whatever is left behind, there's a split of the profit, and 70% goes to the limited partners, and the sponsors take 30%, right? So the GPs, the people who are doing the work, they take 30%, and that's called promote. Now, there's variance. There can be waterfall structures where a sponsor starts off with a 70% split to LPs, 30% to the GPs, but after a certain hurdle is met, so after a certain IRR, and we're going to talk about these metrics, we'll talk more about the fees and metrics on day 2, but after a certain hurdle is met, the split can go to 50-50. There are sponsors who start out with a 50-50 split, 50% to the sponsors, 50% to the LPs. And so, again, this is something where I think there are different perspectives, and I'll tell you why. I think end of the day, you need to look at the returns that are being projected for you as a limited partner. And if these returns already have the fees and the split factored into it, looking at the return and making sure it meets your risk reward profile gives you a better analysis of whether the deal meets your requirements, right? And so so that's the range in terms of what the profit split looks like. We'll talk more about it in day 2. The next question is always going to be fees, right? Are lower fees or no fees better? So let me tell you a little bit about what fees look like. Typically, there is a fee at acquisition for helping, for putting the deal together and doing all the due diligence, putting up the upfront, the capital required for the deal to be able to close, and doing all of that work. Sponsors can charge anywhere from 1% to 3% of the purchase price in acquisition fees. Then there's asset management fee, which is the fee which is separate from what the property managers get paid, but the sponsors may take an asset management fee, which is typically around 1%. It could be 1% of capital invested or 1% of the income that is being generated. So there are different ways of calculating that. So that's during asset management, and then there can be a fee. There could be a fee during exit that's called a disposition fee, which again is typically around 1%. Some sponsors may have these fees, others may not. And it's really important for you, I think, in my opinion, to look at the overall returns after all the fees and the splits have been factored in. And I'll deep dive into this a little bit. But the other thing I wanted to talk about was vertical integration, right? And again, it's one of those things where there are pros and cons to vertical integration. And I've seen people have a preference one way or the other, but again, it's going to be a preference. It's going to be a perspective. There is no right or wrong answer over there. The important thing, in my opinion, because if you have a property manager, if you're vertically integrated, like I've seen institutional institutional players where they have that vertical integration and that property management limb is not performing well, but it's not something they can't fire and hire someone else. When it's a third party, you have more control over how they're performing. You have the ability to replace them if they don't do a good job. So again, the pros and cons over there. Vertical integration may give you a higher return. Again, pros and cons over there. But the overall thing to look at, in my opinion, is always going to be, do the returns meet your risk reward profile? Okay. Now, the different ways of looking at splits. Some people look at no fees and having a waterfall structure like I talked about, where after hitting a certain hurdle, the sponsor is then able to get a higher return. They look at it as incentivizing the sponsor to perform well. But there are different ways of looking at it. That may also mean that the sponsor is really not getting a great return till they hit a certain hurdle, and therefore they may take more risk to get to that point, and that may not be what you want them to be doing. So there are different ways of looking at it. No real right or wrong answer over there. But then I think the thing to remember with splits is that the cumulative preferred return that I talked about, when you're getting, and we'll talk more about this when we talk about the deal per se, when you're getting your cumulative 7% return from the project every year in cash flow as a Class B investor, oftentimes, especially the deals that I've been in, the sponsor has a catch up, which means that until they've paid you your 7% for every year that you're in the deal, they don't get their split from cash flow, right? So there's a lot of different ways to structure it. And I don't think there's a right or wrong answer. As long as you trust the sponsor and as long as the returns make sense for you, I think that's the bigger thing to be looking at. And just to give you perspective, when someone says that there are no fees, the question is the sponsor going to take more risk than to get to promote? But that's, again, it just boils down to character. That's where the brand and having a reputation if their reputation is more important to them, then they're going to do the right thing, right? So that's important to remember. Now, if a sponsor does not have a profit split during the initial part of the investment, now they're putting a lot of time and effort to get to the point where they're producing that opportunity, even to bring you a well-researched, well-underwritten acquisition opportunity. They need to have a really strong team with a lot of people, analysts, asset managers, the people in the acquisition team, and that has tremendous value. That's oftentimes months of work, and then there's at-risk capital over there, and they get compensated for their effort and expense with fees. And so one way of looking at it, and Brian Burke says this in his book, Hands Off Investors, fees are for what they're doing, and then the promote is for the results that they're giving. So there's no right or wrong way. If there is a deal where there are no fees, but your average annualized returns are 8%, right? Versus another deal where you have 2% in acquisition fees, but a 20% average annualized return, and that's after you want to make sure that the numbers they're giving you, that's after the fees are baked in, the fees and the sponsor splits are baked into the projected returns. And then both of those deals have the same risk profile. Which one would you pick? I feel like that is going to be the most important question for you. Okay, great. So we talked about vetting the deal. We talked about vetting the market and vetting the sponsor. The next thing, and like I said, oftentimes it boils down to those returns and really, really understanding those returns. So the next thing we're going to talk about is vetting the deal. What are the performance metrics that you need to be looking at? And you really can't look at those performance metrics without looking at the assumptions that were used to get you to that point. And so next time, we're done for now. Guys, hopefully this was simple. I tried my best to keep it super simple, but understanding the performance metrics, what are industry standards, so you can use that to analyze the deal you're looking at. What are the assumptions that are being used to get to those performance metrics? That is more important than the actual numbers. We'll talk more about fees. We'll talk about debt structures. We'll talk about stress testing the deal. And trust me, you can do this. This is really, I'm going to keep it very easy, very high level, but what you need to be able to do so that you can ensure that the deal fits your risk reward spectrum. I really wanted to break this down because it's actually super simple. And all of you are super smart. It's just that there isn't a lot of conversation around it. And I wanted to be able to break it down, simplify it so that you can use this every time you're looking at a deal. But you can go in really understanding your why first, and then knowing how to vet a deal so that you then look at a deal and say, you know what, this makes absolute sense for me. So that's the goal. I will see all of you again for day 2, which is going to be next Monday at 4 p.m. Okay, thank you guys. You're interested in learning how to invest in long-term and short-term rentals the right way so you can accelerate to financial independence with the support of mentorship, community, and vetted investor agents in strong markets across the country, then get on the waitlist for the next cohort of Creating Generational Freedom at www.generationalwealthmd.com. You don't have to learn from decades of costly mistakes by yourself. The program is only open for enrollment in the spring and fall each year. In the last 6 months alone, our members have acquired over $60 million of real estate, and more importantly, they're living life and practicing medicine on their terms. You don't have to do it alone.